Welcome to Capital Allocation Lab. Subscribe and like to support more educational episodes.
Absolutely.
So, picture this. You buy a bond, you hold it for an entire decade, and the business you invested in is just crushing it.
Right.
I mean, they're generating this incredible 22% return on your specific class of security over that 10-year stretch. The cash is just rolling in.
Sounds like a dream scenario.
Yeah, until you check your brokerage account at the end of the decade, you haven't received anything close to 22%.
I guess.
Yeah. You've been paid a grand total of 6%. And the rest of it, the board of directors just legally kept it.
Right. And there is absolutely nothing you can do about it.
Nothing. It's basically legal theft right out in the open. And the craziest part is it's totally sanctioned by the very contract you signed.
Exactly. And that 22% mirage is exactly why we're doing this deep dive into the source material today.
Yeah, we're looking at how investors get completely blinded by these comforting words on a certificate, words like, bond and guaranteed.
Because the mission for today's lesson is to translate these classic investing frameworks from Graham and Dodd into practical judgment for long-term, fundamentals-minded investors.
People who really want to think clearly as owners.
Right. The core thesis you need to hold on to for this entire deep dive is this. Never, ever buy the label on the certificate.
Never.
Always analyze the actual contract, the underlying earning power, your exact position in the capital structure, and the exact terms of protection.
Well said. But before we get into the mechanics of how that legal theft actually happens, I do need to briefly note that our discussion today is for educational purposes only.
Yeah, we are exploring historical and analytical frameworks here.
Right. This is not individualized legal, tax, or accounting advice. Okay, so we're focusing heavily today on income bonds and guaranteed securities.
Let's start with the income bonds.
Yeah, because when you hear income bond, I mean, your brain instantly latches onto the word bond.
Well, of course it does. It's designed to do exactly that.
You think of a senior obligation. You assume there's this fixed contractual coupon that absolutely have to be paid on time, or else, the company gets dragged into default and bankruptcy court.
And that immediate psychological comfort, that is the trap. To really define an income bond, you have to visualize where it actually sits in the corporate architecture.
Okay, so where does it sit?
It is a true hybrid. It sits in this incredibly precarious middle ground, right between a straight, traditional fixed-interest bond and a preferred stock.
Okay, so how is it like a bond?
Well, on one side, it mimics a bond because it usually has a stated specific maturity date. There's a fixed point way out in the future where the company legally owes you your principal back.
Right, but the reality of that maturity date is, well, it's basically a joke, isn't it? I mean, we aren't talking about a 3-year treasury bill here.
No, not even close. The maturity on these instruments is frequently decades away.
Like how long?
Sometimes 50, 75, or even a full century in the future. And because that principal repayment is so far over the horizon, its present economic value to you...
The investor living right now.
Exactly. To you, it's mathematically negligible. Your actual lived experience holding the security is going to be dominated entirely by the other side of its hybrid nature.
The equity-like income terms.
You got it, which is exactly where the word income steps in and ruins your day.
Right, because unlike a straight bond, the interest payments on an income bond are not strictly mandatory, are they?
No, they are contingent. They are tied directly to the company's income or its earnings. If the earnings aren't there...
You don't get paid.
Right. Or, and this is the really critical part, if those earnings aren't deemed available under the specific, dense legal terms of the indenture, you still don't get paid.
And the company doesn't default?
Nope. They just smile, shrug, and keep operating normally.
Wait, I need to stop you there because to a lot of people listening, this is going to sound like an obvious contradiction.
How so?
Well, if the payout is contractually based on earnings, doesn't positive earning power practically guarantee a payout?
You would think so.
I mean, if I'm looking at the income statement and the business is just printing cash, I should get my money, right? It seems like a straight line. They make money, I make money. Where's the disconnect there?
The disconnect is a concept called contract interpretation risk. And it's mixed with some really intense governance risk.
Okay, let's unpack that.
When you buy an income bond, you aren't just betting on the economic viability of the business model. You are betting heavily on the benevolence
The board.
and the strategic priorities of the board of directors.
Right.
Because the indenture, the governing legal contract, almost always features clauses that give the directors immense discretion.
So they can look at that massive pile of available income.
And legally divert it, exactly. They might decide, hey, we need to fund some massive capital expenditures.
Like building a new plant.
Right. Or they might say, we need to build up our reserve funds for a rainy day. And they can do all of this before they ever officially declare what's left over for the income bondholders.
Wow. So management can just look at a mountain of cash, point to a factory they want to build, and totally legally starve the very bondholders who financed them in the first place.
They absolutely can. And historically, they did it all the time. You're placing your trust in management's decision-making framework just as much as the business economics.
Which brings us directly back to that wild example I mentioned at the very beginning of the lesson.
Right.
That wasn't a hypothetical.
No, that is the brutal historical reality of the Green Bay and Western Railroad.
Yeah, let's walk through the actual historical data on that one. We're looking at their Series B income debentures.
Right, from 1922 through 1931.
A full decade. And over that decade, the railroad's underlying business was genuinely successful.
Very successful. They generated earnings that equated to nearly 22% on those specific debentures.
Okay, so if you're a purely quantitative investor, just screening for underlying earning power, you look at that security and you feel incredible. The cash is undeniably coming through the door.
But then you wait by the mailbox for your interest checks.
And you keep waiting. Because over that entire 10-year period, the holders of those Series B debentures received aggregate payouts of roughly 6%.
6% over 10 years.
While the company earned 22. I mean, how on earth do investors not riot in the streets over that? How is that legally permissible?
Because it was explicitly written into the contract. And the investors simply didn't read it, or they willfully ignored the implications.
They just bought the label.
Exactly. The indenture gave the board the explicit right to interpret what constituted available cash. And the board decided that reinvesting in the railroad...
Grading tracks, buying new train cars.
Right, strengthening the balance sheet. They decided that was a much better use of the cash than paying the junior bondholders.
And they acted entirely within their legal rights.
Completely. The investors bought that comforting label debenture, assumed fixed income safety, and woke up to realize they held this subordinate equity-like claim where management held literally all the leverage.
Okay, so if these instruments are basically legal traps where the board holds all the cards, how did they even become a massive asset class in the first place?
That's a great question.
I mean, if I'm a high-quality company today, why would I issue a bond that basically tells investors, I'll pay you if I feel like it?
Right.
Furthermore, if income bonds sit legally higher in the capital structure than preferred stock, meaning they absolutely get paid before the preferred shareholders do, shouldn't the market value them more highly? Shouldn't they have a pristine reputation?
In a purely theoretical academic world, yes. If a claim is contractually senior, it should mathematically be safer, and therefore it should command a higher investment rating.
But I'm guessing reality diverges from theory here.
Wildly. The market isn't a sterile laboratory, you know? It's a complex sociological environment, and historically, income bonds carried a deeply toxic stigma.
How toxic?
Well, our sources point out this amazing fact. Out of the vast entire universe of these securities, only one single issue managed to maintain a long-term, respected investment standing.
Just one issue out of the entire market.
Just one. The Atchison, Topeka, and Santa Fe Adjustment 4s due 1995.
Wow. Why was the market so relentlessly biased against an instrument that was, legally speaking, senior to preferred stock?
To understand that, we have to look at what we can call the reorganization residue.
Okay, what does that mean?
You have to ask yourself, under what circumstances is an income bond actually born? Historically dominant, thriving companies looking to optimize their cost of capital did not invent income bonds.
They weren't born in a boardroom of a booming business.
No, they were born in the ashes of distress. They were forged in bankruptcy courts and corporate reorganizations.
Ah, I see. So they were strapped onto the backs of companies that already had this heavy capital structure and a history of troubled credit.
Precisely. A bloated capital structure collapses, the company can't pay their fixed interest bonds, and the bankruptcy judge steps in.
And the reorganization committee looks at the bankrupt company and basically says, look, you obviously can't handle fixed mandatory interest payments.
So we're going to force the old, distressed bondholders to surrender their fixed claims.
and accept this new compromise instrument.
Right. One where the company doesn't legally have to pay if it has a bad year, and that new instrument was the income bond.
So the market isn't stupid. Over decades, investors learned to instinctively associate the mere existence of an income bond with a company that had previously defaulted.
Exactly. There's an incredible analogy in the source text that makes this click instantly.
Yeah, the mortgage bond analogy. I love this one.
Right. Imagine if a country passed a cultural rule where corporations only ever issued mortgage bonds when their credit was doubtful, when they were on the verge of collapse.
Right, so if they were healthy, they issued debentures. But if they were dying, they issued mortgage bonds.
Even though a mortgage bond is legally backed by hard assets and technically should be safer, that cultural habit would ruin the asset class.
Because the moment a company issued a mortgage bond, the entire market would instantly think, uh-oh, they must be desperate.
Exactly. The legal form doesn't matter. The stigma of desperation attaches to the tool itself. That is exactly how capital markets operate.
The psychological baggage just totally outweighs the legal hierarchy.
It does. But, as rational analysts, we can't just live in the historical baggage. We have to apply a forward-looking method.
Because a financial instrument is ultimately just a tool.
Right. A hammer can be used to build a beautiful house, or it can be used to smash a window. And strong companies might eventually issue income bonds for highly rational reasons.
Like what?
Well, in a modern context, a highly profitable company might realize that income bonds offer a massive structural tax advantage. The interest paid on a bond is generally tax-deductible for the corporation.
But the dividend paid on a preferred stock is absolutely not.
Exactly. So a perfectly healthy company might issue an income bond simply to harvest that tax reward, completely independent of any financial distress.
So the practical framework for you, the listener, when you are looking at a modern prospectus and you see an income bond, is to ask, why does this exist?
Right. What is the motive?
Is it a highly sophisticated management team optimizing their after-tax cost of capital? Or is this just a desperate compromise from a weak business trying to survive without fixed charges?
You have to diagnose the motive before you even look at the math. But once you
Ah.
do establish that motive, the math becomes your absolute foundation.
You cannot escape the numbers.
Ever.
So let's get into the analytical core here. When an investor actually sits down, pulls up the financial statements, and tries to do the math on an income bond, what is the primary unbreakable rule?
The unbreakable rule is that an income bond must be analyzed exactly as if it were a preferred stock.
Okay, do not let the word bond trick you into analyzing it like standard fixed interest debt.
Exactly. And this is where we have to talk about the trap of isolated coverage.
Oh, this drives me crazy. You still see this all the time on modern financial portals and automated statistical services.
It's incredibly deceptive. These services flatter the securities. They'll take this one specific tiny income bond issue, they isolate its specific interest requirement, and they compare it directly against the massive total earnings of the whole corporation.
Right. So say a company has $10 million in total operating earnings, and the interest required for this specific junior income bond is only like $500,000.
The automated screener just divides 10 million by 500,000 and spits out a coverage ratio of 20 times.
And the naive investor sees 20x coverage and thinks, wow, this is the safest investment on earth. The earnings could plummet 90% and I'd still get my coupon.
But that is a catastrophic illusion.
Why? Why does that math completely fail in the real world?
Because it completely ignores the physical reality of the capital stack. It ignores hierarchy. Cash does not just magically teleport to the junior bondholders.
It has to flow through a waterfall.
Yes, you must factor in the entire capital stack. All the senior bonds, all the prior fixed charges, all the mandatory deductions that stand in line ahead of you.
Right. If you isolate a junior claim and ignore the billions of dollars of senior debt that have the legal right to drain the cash pool before you see a single penny.
You are analyzing a fantasy.
Okay, we're going to walk through a historical deep dive to permanently cement how this math actually works.
Yes, let's look at the MKT Railroad, the Missouri-Kansas-Texas Railroad.
Specifically for the calendar year 1930. Now, if you are listening to this, I really want you to actively visualize a giant funnel. Cash is pouring into the top of the funnel, and there are multiple filters it has to pass through before it reaches the bottom.
We're going to calculate exactly how much cash gets trapped at each filter.
Right. Let's lay out the starting figures for the very top of our funnel.
Okay, so in the 1930 calendar year, the MKT Railroad generated a railway operating income net after taxes of approximately $13.353 million.
Okay, $13.353 million.
Concurrently, their gross income was reported at roughly $12.009 million.
Wait, let's pause right at the top.
Yeah.
The net after taxes was $13.353 million, but the gross income was only $12.009 million.
Yeah.
The net is actually higher than the gross. How does that happen?
It's a weird quirk of how railroad accounting and non-operating income functioned at the time. It involved equipment rents and joint facility incomes that were credited after certain operating taxes.
Okay, but that accounting quirk forces us to make a crucial analytical decision, right?
It does. Because the net after taxes physically exceeded the gross income, rigorous methodology dictates that we cannot use a simple gross income calculation. We must use what's called the net deductions test.
Oh, net deductions test, okay.
Right. We have to find the true, inescapable burden on those core operating earnings. So, back to the numbers. Their fixed charges, the mandatory senior interest payments they legally had to make, were about $4.230 million.
Okay, so after paying those senior obligations and adjusting for the rents, what was the actual balance of cash that flowed down and became available for this specific income bond we are investigating?
The balance for the adjustment interest was about $7.779 million.
$7.779 million. Got it. And what did the adjustment bondholders actually need to be paid? What was their specific charge?
Their specific interest charge was tiny. It was only about $696,000.
$696,000. All right. And if we look even further down to the very bottom of the funnel, after paying that adjustment interest, what was left?
The balance left for dividends, the net income was about $7.083 million. And the preferred stockholders sitting at the bottom needed about $4.645 million of that to get their dividends.
Okay, so the hierarchy is totally established. We have heavy senior fixed charges at the top. We have this tiny $696,000 adjustment interest right in the middle. And we have a massive $4.645 million preferred dividend requirement at the very bottom.
Exactly. Now let's walk through the net deductions math to see how safe each layer actually is.
Walk me through it.
First, we need to find the total senior burden. We take the net after taxes at the very top of the funnel. That's the $13.353 million.
Right.
And we subtract the balance that was actually available for the adjustment interest, which was $7.779 million.
Okay, so $13.353 million minus $7.779 million. That leaves us with $5.574 million.
Exactly. That $5.574 million represents the net deductions, the true comprehensive senior burden that gets trapped in the first filter before our income bond even enters the conversation.
Right. It's the wall of money that has to be paid before we get a dime.
So now we are going to run 3 different coverage scenarios. This is going to prove how your safety profile radically degrades depending on where you sit in the waterfall.
Okay, scenario 1.
Scenario 1 is for the senior fixed interest bondholder sitting at the very top. We take the total net after taxes, $13.353 million, and divide it by their specific net deductions burden of $5.574 million.
Okay, 13.353 divided by 5.574 gives us roughly 2.4 times coverage.
Right. So the operating earnings covered the senior burden almost 2.5 times over.
And as an analyst, you would look at a 2.4x coverage ratio for a senior railroad bond in 1930 and conclude that it is reasonably protected, right?
Absolutely. That is a solid earnings cushion. If earnings drop by half, the senior bonds still get paid.
Okay, but now we step down a level. Scenario 2. We are the income bond holders now. We cannot just divide $13 million by our tiny $696,000 requirement.
No, we have to carry the weight of the senior debt above us.
So we take that senior burden of $5.574 million, and we add our adjustment interest requirement of $696,000.
Which gives us a new, heavier, cumulative deduction burden of $6.270 million.
Right, so now we divide the top line net after taxes by this new cumulative burden. $13.353 million divided by $6.270 million. That drops our coverage ratio down to about 2.14 times.
Now, to a novice, 2.14x still sounds decent, but under strict fundamentals-based analysis, a 2.14x coverage ratio for a junior hybrid claim fails a minimum threshold for a fixed value investment.
Why does it fail? 2.14x is still more than double the requirement.
Because it lacks the legal protections of a senior bond. An income bond requires a much, much wider margin of safety to compensate for its structural weakness. At 2.14x, it is starting to look highly vulnerable to any real economic shock.
Wow, okay. And then we plunge to the very bottom of the capital stack, scenario 3. the preferred stock.
Right. We take the previous cumulative burden of $6.270 million, and we add the massive preferred dividend requirement of $4.645 million.
Which balloons the total required cumulative deductions to an enormous $10.915 million.
Exactly. Finally, we divide the $13.353 million in earnings by the $10.915 million cumulative burden.
And that gives us a microscopic 1.22 times coverage.
And the analytical conclusion here is absolute rejection. A 1.22x coverage ratio for a preferred stock is wholly inadequate.
Because even a minor economic hiccup, a slight increase in labor costs, a tiny dip in freight traffic will instantly wipe out the earnings available to pay those dividends.
It is violently speculative.
This totally shatters the illusion of the isolated coverage stat. If you had just isolated that tiny $696,000 adjustment interest, you would think you had nearly 20 times coverage.
But when you do the grueling cumulative net deductions math and force yourself to acknowledge the billions of dollars of legal rights ahead of you, your coverage is actually only 2.14x.
The fantasy just evaporates. Capital structure is reality, not optional theory.
Which perfectly bridges us into the next phase of our framework, because doing the math on the day you buy the security, that's only half the battle.
Right. Surveillance is mandatory. We have to talk about the danger of reaching for yield, because the blueprint of a company doesn't just freeze in time.
No, it doesn't. You can do all this cumulative math in 1930, but the world keeps spinning.
So let's trace what actually happened to the MKT Railroad immediately after we ran those numbers.
Okay. In 1930, that 2.4x coverage for the senior bonds indicated a reasonable margin of safety. It wasn't a foolish investment. But then the macroeconomic environment violently shifted.
A Great Depression.
Exactly. From 1931 through 1933, the railroads suffered a disastrous, sustained decline in earnings.
The funnel just dried up. The amount of cash pouring in at the top shrank drastically.
It did. But here is the profound insight regarding margin of safety. Because those senior fixed-interest bondholders had demanded that 2.4x cushion initially, that cushion absorbed the initial blows of the Depression.
Oh, I see.
Margin of safety isn't just about protecting your principal, it buys you time. As the earnings deteriorated week by week, month by month in 1931, the vigilant investor had a window.
They had ample time to watch the coverage ratio slip from 2.4x to 2.20x down to 1.5x, and they could execute an advantageous sale before the bonds completely collapsed.
Exactly. Credit work is buy and verify, not buy and forget.
I love that. Buy and verify.
Right.
But what happens when investors don't verify? When they completely ignore the structural degradation?
You have this phenomenon of late-cycle heedlessness.
Let's talk about the post-1934 price history of those exact same MKT bonds, because it's a masterclass in this psychological flaw.
It really is. By the mid-1930s, the earnings had collapsed so severely that the interest on the junior adjustment bonds, those income bonds we just analyzed, was completely skipped.
The board just turned the faucet off.
They paid nothing for years. They finally managed to pay a coupon in 1937. And yet, look at the market behavior in the high-flying markets of 1937.
This is the part that blows my mind. Buyers in 1937 were frantically paying the exact same price for those highly speculative junior adjustment 5s as they were paying for the rock-solid senior 412s.
Yes.
Let's unpack the insanity of that. You have a senior bond that has priority legal claim to the assets, yielding 4.5%. And you have a junior bond that has literally starved its investors for years, yielding 5%.
And the market priced them identically.
Why? Why would a supposedly rational market pay the same dollar amount for a junior claim as a senior claim?
Because of the seductive poison of reaching for yield, late in an economic cycle when confidence is high and recent memories of default kind of fade away, investors systematically compress quality distinctions.
They just look at the 5% yield on the junior bond, they look at the 4.5% on the senior bond, and their greed isolates that tiny difference.
Right. They say, I want the extra 50 basis points. And to get it, they completely ignore the catastrophic difference in structural safety.
They price unlike things as if they were exactly alike.
They trade a steel vault for a cardboard box just to get 0.5% more interest.
And when the cycle turns, the cardboard box gets crushed.
Every time. Now, before we transition away from the income bond landscape, there's one last kind of bizarre complication we have to clarify.
Right. Senior income bonds.
Yeah. Sometimes a bond is labeled an income bond, meaning the interest payout is completely discretionary, but it actually sits senior in legal lien hang to fixed interest
Okay,
bonds.
like the Atchison Adjustment 4s that we praised earlier.
Exactly. They operated exactly this way. They had a prior superior legal claim on the hard assets, even though their interest was contingent.
So how do you analyze that? It forces the analyst to hold two conflicting ideas simultaneously.
The rule here is absolute. You must treat this contingent interest as part of the company's fixed charges when you do the math.
Treat it as fixed. Why?
Because hierarchy and lien outrank the label of the security. If a claim has a legal senior right to the physical assets of the business before you do, you must deduct it before calculating your own safety.
Regardless of whether its interest is labeled fixed or contingent.
Exactly. The physical reality of the lien dictates the math. Always.
Okay, so let's briefly recap the income bond section before we transition. We've established that income bonds are suspended in this dangerous purgatory between debt and equity.
Right?
We learned that their historical toxicity comes from their birth in bankruptcy courts and reorganizations. We walked through the grueling waterfall of cumulative deductions to prove that you can't ignore the senior debt above you.
And we highlighted the fatal psychological trap of reaching for yield late in a cycle.
Trading structural survival for a tiny sliver of extra yield. Perfect.
And, if you thought the word bond created a dangerous psychological shortcut, it pales in comparison to the subject of our next segment.
Guarantees.
The allure and the illusion of guaranteed issues.
There is arguably no word in the English language more seductive or more anesthetizing to an investor than the word guaranteed.
It's the ultimate psychological shortcut.
The moment an investor sees that a bond is guaranteed by a massive parent company or a government entity, their analytical brain just shuts down. They stop running the cumulative deductions math. They stop looking at the underlying business.
Which is the exact opposite of what a fundamentally sound investor must do. Because the counter-narrative, the brutal underlying reality is this. A guarantee is only exactly as strong as the guarantor's balance sheet.
Right. A guarantee is not a magical incantation.
No, it does not conjure cash flow out of the ether. It is merely a contractual promise made by a second entity. If that second entity goes broke, their promise is financially worthless.
And the market's historical skepticism around guarantees didn't just manifest out of thin air. There's a deeply unsettling historical context that really poisoned the well here.
The Kanawha and Hawking Coal and Coke Company case.
Yes. Explain what happened there.
In this instance, a massive, supposedly reliable guarantor, a major railroad company, actually attempted to escape its liability on a guarantee it had explicitly signed.
How did they try to do that?
Well, when the underlying coal company struggled and couldn't pay its obligations, the bondholders naturally went to the railroad and said, "Hey, you guaranteed this paper, pay up."
Right.
And the railroad's legal defense was shocking. They argued that the act of guaranteeing the coal company's debt was ultra vires.
Ultra vires. Meaning what, exactly?
Meaning it was completely beyond their legal corporate powers as defined by their charter.
Wait, how does a massive corporation just claim they weren't legally allowed to sign a contract they already signed? Were the executives lying, or is corporate law just that malleable?
Well, in the early 20th century, corporate charters were often very strictly and narrowly defined. If a railroad's charter said, "We operate trains," and didn't explicitly authorize them to act as an investment bank underwriting coal debt, a clever lawyer could argue the executives acted outside their legal bounds.
And therefore the contract is void.
Exactly. They tried to use this legal technicality to completely abandon the bondholders, leaving a massive residue of market distrust.
That is terrifying. You buy a bond thinking you have an ironclad guarantee from a blue-chip railroad, and their lawyers turn around and say, "Oops, our bad. We weren't actually allowed to sign that document, so you get nothing."
It is terrifying. But we must balance that historical fear with modern reality. Our sources are clear. Ultimately, no major solvent company has successfully escaped a guarantee on purely legal ultra vires technicalities in modern jurisprudence.
So courts generally enforce the spirit of the contract now.
Yes, recognizing the reliance of the investor, provided the guarantor actually has the capital. The real pressing risk for you today isn't usually a clever legal loophole. The real risk is simply that the guarantor runs out of cash.
So practically speaking, if I'm officially ranking a guarantee today, where does it sit? What is the true status of a guarantee?
Legally, a guarantee ranks equally with the unsecured debt, the debentures of the guarantor.
Okay.
It sits alongside their general uncollateralized promises to pay suppliers and unsecured creditors. Crucially, it sits superior to the guarantor's own preferred stock and common equity.
Okay, let's visualize this. Company A guarantees the bonds of Company B. Company A goes completely bankrupt. That guarantee claim from Company B's bondholders is thrown into the bankruptcy pool right alongside Company A's unsecured bondholders.
Correct. It doesn't get special super priority, it doesn't get secured by the factories, but it does legally beat Company A's stockholders.
Got it. But this brings us to an incredibly nuanced scenario. The concept of independent strength.
This is crucial.
What if the guarantor fails, but the underlying issue, the actual business, is great? We naturally assume that if the parent guarantor dies, the child's security dies with it.
But that's not always true. We have two phenomenal historical examples of this from the text. The first is the Brooklyn Union Elevated Railroad Fives.
Walk us through it.
In the Brooklyn Union case, the guarantor went into complete receivership. It collapsed entirely. But the Brooklyn Union Elevated Railroad Fives survived completely unscathed. They didn't miss a single beat.
Why? How did they survive?
Because the underlying system, the actual elevated physical railroad operating in Brooklyn, was so strategically vital to the transit network and generated such immense independent earning power that it simply didn't need the guarantor's money.
Its own intrinsic position protected it entirely from the parent's failure.
Exactly. And the second example is the U.S. Industrial Alcohol Preferred Dividends. The guarantor, the Distilling Company of America, went totally bankrupt.
And what happened to the preferred dividends?
The U.S. Industrial Alcohol Company just kept paying its dividends out of its own massive earnings. They were so successful, they eventually retired the preferred stock at a premium, paying 125% of par value long after the guarantor had died.
What's so fascinating here is how it shatters the lazy heuristics of the market. Investors love to think guarantee equals good, no guarantee equals bad.
But these examples prove that the fundamental underlying asset matters immensely. If the asset itself is a fortress, a worthless guarantee doesn't drag it down. The asset stands on its own 2 feet.
Let's talk about how this dynamic plays out with guaranteed stock, because this flips the traditional hierarchy completely on its head.
Right.
If a parent company guarantees the dividend on a subsidiary's common or preferred stock, how does that guarantee function analytically?
Analytically, it functions exactly like debt to the guarantor. Even though the instrument is technically labeled stock at the subsidiary level, the parent company has made a hard contractual promise to pay a fixed monetary amount.
So that promise transforms into a liability.
Yes, it is a debt obligation sitting squarely on the parent's balance sheet.
And the market can actually be remarkably efficient at pricing this transformation when it pays attention. Look at the Anacostia and Potomac River Railroad First Fives, due in 1949.
This is a brilliant case study.
Yeah, there was one single identical bond issue, but a specific portion of these exact same bonds were guaranteed by a very strong parent company, the Washington Railway and Electric Company.
And the rest of the bond issue was totally unguaranteed.
Right, so how did the market price these legally identical underlying assets? The guaranteed portion sold at 110, a significant premium over par.
And the unguaranteed?
The unguaranteed portion, identical in every single way except for that one parent signature, sold at 80, a deep discount.
Wow.
The market perfectly isolated the independent strength of the asset itself, pricing it at 80, and then correctly priced the credit enhancement of the guarantor's signature at an extra 30 points.
That is a rare example of perfect market efficiency. But, and this is a massive flashing red but, you only ever get what the contract explicitly promises.
Which brings us to reading the fine print, the exact terms.
The most critical part of this entire lesson. You cannot, under any circumstances, buy on the strength of an unread guarantee. You have to open the dense legal indenture.
And the first most crucial distinction you have to look for is the difference between an interest guarantee and a principal guarantee.
What exactly is the guarantor legally on the hook for? Let's look at the Philippine Railway First Fours due 1937. The government itself guaranteed these bonds.
And when an average investor hears government guarantee, their brain immediately translates that to zero risk, risk-free asset.
But there is a massive catch hidden in the text. The government only guaranteed the interest payments. They explicitly did not guarantee the repayment of the principal amount at maturity.
Oh, wow. And the result was entirely predictable.
Completely. The underlying railway was a terrible business with abysmal earnings. The government, being a reliable guarantor, faithfully paid the pumped interest coupons every single year, exactly as promised.
But when the clock ran out in 1937 and the massive principal amount came due, the railway obviously couldn't pay it.
And the government simply pointed to the contract and said, not our problem, the principal defaulted.
And the market saw this reality coming from miles away, didn't it?
It did. Despite the shiny government guarantee label, the price of those bonds in the open market was capped at roughly 39 cents on the dollar. Professional investors ran the math and knew that once the guaranteed interest stream expired in 1937, the residual principal was effectively zero.
Let's contrast that with a domestic example that illustrates this duration effect even more dramatically. The Minneapolis, St. Paul, and Sault Ste. Marie Railroad.
Yes, their first consolidated 4s and 5s that were due in 1938.
It was a nearly identical structural situation. They were guaranteed as to interest only by the Canadian Pacific Railway.
And when they hit their maturity date in 1938, the principal violently defaulted. Canadian Pacific legally fulfilled its obligation to pay interest right up to that maturity date and then instantly stopped paying.
The price of those bonds utterly crashed, plummeting from near par all the way down to 6 cents on the dollar.
But here is where the analytical mind gets blown. That exact same bankrupt railroad had another issue outstanding. The junior refunding 512s.
Legally junior.
Right. They also only had an interest-only guarantee from the Canadian Pacific, but they weren't due in 1938. Their maturity date was 1978, 40 years later.
40 years. This is a profound, unforgettable lesson in the power of duration.
Because those legally junior bonds had 40 more years of guaranteed interest payments contractually promised by a highly solvent guarantor, that guarantee retained immense present value.
Even though the underlying company was in bankruptcy and the senior bonds had crashed to 6, these junior, long-dated bonds traded robustly around 64.
Duration completely inverted the traditional rules of the capital structure. It perfectly illustrates why the exact, specific terms of the contract matter exponentially more than the broad label.
A long-term interest guarantee acts mathematically like a valuable annuity. A short-term interest guarantee is nothing more than a temporary Band-Aid slapped over a fatal wound. When the Band-Aid falls off, you bleed out.
And speaking of temporary Band-Aids, we have to explore what happens when limited duration guarantees simply run out of time.
Let's look at the American Telegraph and Cable common stock.
Western Union, which was an absolute titan, a massive blue-chip monopoly at the time, guaranteed a 5% dividend on this stock for 50 years.
But the agreement was structured as a long-term lease that would ultimately legally end in 1932.
Right. And for decades, investors received that 5% dividend check, like absolute clockwork. They got so incredibly used to it that they began treating it as a permanent, immovable fixture.
In 1922, just 10 years before the lease was scheduled to expire, investors were still actively buying the stock at $70 a share.
They were mathematically capitalizing a temporary, evaporating cash flow as if it were a perpetual bond.
But the underlying physical reality was incredibly grim. The actual telegraph cables owned by the company were rusting and becoming technologically obsolete.
So when the calendar finally flipped to 1932, Western Union legally walked away. The guarantee evaporated into thin air.
And the investors ended up with a residual settlement of roughly $20. They lost more than 2/3 of their principal simply because they refused to respect the limited duration printed on the contract.
They bought the label and willfully ignored the ticking clock. Now we have one more type of fine print caveat to examine, and this is arguably the most insidious type of all, the conditional guarantee.
Most dangerous type, the caveats.
This brings corporate structure and legal subordination to the forefront. The Pratt Whitney preferred stock case is the quintessential warning label for this danger.
If you looked at the standard stock manuals of the era, they clearly stated that the Pratt & Whitney dividend was guaranteed by its parent company, Niles Bedment Pond.
On the surface, it looked rock solid. But if you actually took the time to open the legal document, you'd find a devastating caveat hidden in the fine print.
The condition.
Yes. The parent company only agreed to pay the Pratt & Whitney dividend if and only if the parent company had surplus earnings left over after paying its own preferred dividends first.
Oh, wow. So it was a strictly conditional promise. They were basically saying, we will absolutely guarantee your payment, provided we have lots of extra cash lying around that we don't need.
Exactly. And the economy is cyclical. Companies invariably hit hard times. From late 1924 stretching into mid-1926, the parent company struggled. They did not generate those required surplus earnings.
So the specific mathematical condition of the contract was not met.
Therefore, the supposed guarantee was legally deactivated. The Pratt Whitney holders received absolutely nothing from late 1924 to mid-1926.
And they had zero legal recourse. They couldn't sue, they couldn't force a bankruptcy because the parent company was following the explicit letter of the contract.
Which permanently cements the golden rule we established. Never buy a security on the strength of an unread guarantee. If there is an if, a but, or a provided that hidden in the text, you do not hold a guarantee, you hold a contingency.
But we shouldn't just focus on the negative traps. This brings us to a structural variation that is actually incredibly favorable and protective for the investor, provided it is understood correctly.
The immense power of joint and several guarantees.
Yes, joint and several. It sounds like archaic legal jargon, but it is actually a massive, tangible structural advantage. Break down exactly what makes a guarantee joint and several.
It indicates a structure where multiple legally separate sponsors, usually parent companies or major stakeholders, are collectively involved in guaranteeing a single security. The word joint means they are all collectively responsible as a group, but the true magic is in the word several. Several means that every single individual guarantor within that group can be legally forced to stand behind the entire liability on their own, even if every other guarantor fails.
Wait, let me make sure the listener is internalizing the scale of this. If 5 massive corporations jointly and severally guarantee a $100 million bond issue, and then a catastrophic depression hits, and 4 of those giant corporations go completely bankrupt.
The bondholders can literally walk up to the 5th surviving company and say, you individually owe us the full $100 million.
That is incredible. The last survivor absorbs the full, undivided burden. It creates an interlocking network of financial resilience.
Let's look at the historical proof of this. The Kansas City Terminal Railway Company first 4s due 1960. These terminal bonds were backed by a joint and several guarantee from 12 different railroad companies that utilized the terminal hub.
12 separate corporate balance sheets.
And out of those 12 railroads, at least 3 of them were consistently, fundamentally strong enough to cover the entire massive terminal payment on their own without breaking a sweat.
So logically, even if 9 major railroads went simultaneously bankrupt, the bond would remain utterly pristine because of the remaining 3 powerhouses?
Exactly. But did the broader market actually appreciate or properly price this incredible structural resilience?
I'm guessing no.
No. The market routinely failed to price this superiority correctly. They would look at a generic bond guaranteed by one decent railroad and price it exactly the same as the Kansas City terminal bond guaranteed by 12.
They completely, systematically undervalue the geometric increase in safety, which leads us directly to the most illustrative lesson of this entire analysis: the federal land bank comparison.
The ultimate masterclass in structural stress testing.
Let's set the stage. We have 2 distinct types of agricultural bonds trading in the open market. On one side, we have the federal land bank bonds, 12 regional agricultural banks with a mutual guarantee. They guaranteed each other's debt jointly and severally.
They were a pack.
Right. On the other side, we have the joint stock land banks, operating in the exact same agricultural industry, but they explicitly had no mutual guarantee. Every individual bank stood entirely on its own balance sheet.
They were lone wolves. So how did the market price these 2 radically different structural risks?
Investors, perpetually lured by yield, priced them almost identically. The joint stock land banks, the lone wolves with zero mutual backup, yielded only about 0.5%, 50 basis points, more than the structurally bulletproof federal land bank bonds.
People literally forfeited a 12-bank, joint, and several safety net just to earn an extra 0.5% on their money.
And this is where we introduce the middle ground stress test scenario.
Right. In total success, guarantees don't matter at all because not a single bank fails. The lone wolves do just fine.
And in total apocalyptic failure, the mutual guarantee is also useless because all 12 guarantor banks go bankrupt simultaneously.
But the real world lives entirely in the messy middle, regional distress. Some banks fail, some banks thrive.
And in that messy middle, the mutual guarantee is profoundly valuable. The highly profitable regions can easily absorb the localized losses of the weak region.
But the lone wolf banks, they just go instantly bankrupt and wipe out their investors.
And what actually transpired historically?
The messy middle arrived in the early 1930s. The joint stock land banks defaulted to deeply speculative prices. Their investors were financially ruined.
But the federal land banks.
They experienced zero defaults, not a single one. The lesson here is written in financial blood. Extra yield is never, ever free. Small yield differences often hide large structural sacrifices.
That is an incredibly powerful note to begin weaving these threads together into our practical takeaways. The overarching theme is that labels bond, income, guaranteed are cheap. Investors must convert labels into substance.
Let's explicitly list the 8 rules we've derived. Number 1, analyze income bonds as hybrids. They have a distant maturity and discretionary interest.
Number 2, never accept isolated coverage stats. Calculate downward from the whole enterprise.
Number 3, a security's historical quality reflects who tends to issue it, like reorganizations.
Number 4, a guarantee is only as good as the guarantor, and exact terms meaning interest versus principal and interest, duration, and conditions.
Number 5, a guaranteed issue can be strong independently or weak despite the label.
Number 6, joint and several guarantees deserve special respect and valuation.
Number 7, post-purchase surveillance is mandatory. Change your judgment when the exhibit changes.
And number 8, small yield differences often hide large structural sacrifices.
Beautifully summarized. And why must equity investors, common stock buyers, understand this?
Because capital allocation begins entirely with capital structure literacy.
Exactly. Every single layer above the common stock dictates the residual value. You literally cannot value the equity without first stress testing the debt.
Which brings us full circle. Do not trust the adjective, analyze the obligation.
The promise is only as good as the business, the balance sheet, and the contract that supports it. Hierarchy, coverage, and terms.
Thanks for joining. Our mission at Capital Allocation Lab is to teach disciplined, long-term investing by revisiting classic books and core ideas, explained clearly in today's context, so you can make better decisions as an owner.
If you found this useful, like the episode and subscribe. It really helps us keep these lessons free.
And please give a comment with your questions, your disagreements, or the fundamental investing concept you'd like us to tackle next time.
Margin of safety, owner earnings, capital structure, preferred stock, buybacks versus dividends, return on invested capital. Tell us what would sharpen your judgment most.
Thanks for listening.
We'll see you in the next lesson.